mortgage-backed security portfolio, and you typically kind of tranche them. Even the simplest structure typically had a senior tranche, mezzanine tranche, and junior tranche. You did the senior tranche so that it gets double A rating. You do the mezzanine so that it gets investment banking, investment grade rating. The importance is if something is double A rated or higher, pension funds, public pension funds, are allowed to invest in them. Think about the CalPERS, the California Employees Pension Fund. It's huge, okay? But if you're only single A rated, by law, CalPERS cannot invest in them. And the other one, mutual funds who are not directly in the business of speculating on default rates cannot invest into bond type securities that are not investment grade. And whatever you have left is basically crap of the crap. I mean, I can take what we used to call those days subprime mortgages, put them in a pool. I could create a double A rated tranche, triple B rated tranche, and the rest is complete crap. But if the housing prices were going up, that crap part kept going in value. And the 1 year before Merrill Lynch went down, the guy who was in charge of uh, global fixed income got $175 million in bonuses because his desk made so much money. In fact, the guy retired after getting that bonus. One of my friends who was running Merrill Lynch Tokyo at the time, he was appointed as the new head of global fixed income. Of course, things crashed. He lost all of his unvested options and everything, got nothing. In fact, only two people were fired at the top management, the new CEO and this guy, even though they had played no role in building up that portfolio. And a portfolio like that, you cannot simply get out by saying, I'm going to get out. It takes a while to unwind all those transactions. It's not like dumping a portfolio of treasury securities. And another victim was AIG. Uh, if you know, AIG is actually an insurance company. It's American Insurance Group. There were late 90s to early 2000s. It became very popular for people to invest into what we now call credit default swaps. It's basically a simple agreement. Let's say I'm carrying bonds of Merrill Lynch. I'm concerned about Merrill Lynch defaulting. So I come to you and say, okay, how about let's do an agreement? I have $1 million worth of these Merrill Lynch bonds. Over the next 5 years, if Merrill Lynch defaults, you're going to pay me $1 million. I'll give you the bonds. You do whatever you want with it. That's a swap. In the meantime, every year, I'm going to pay you an insurance premium, maybe 3%. So every year, you're going to get $30,000 from me. If Merrill Lynch doesn't default, nice, you got your money, right? But if it does, you're going to have to pay me back, just like a car insurance. AIG figured, hey, we're in the insurance business, so this is kind of insurance. They did a lot of these things. And when the markets crashed, all those calls to be made whole started coming in, and AIG effectively became insolvent. Treasury actually had to take them over. If Treasury had not taken over AIG, even JP Morgan, Goldman Sachs, they would have been completely wiped out. And the entire US financial system would have been wiped out. They basically put them into a bad toxic assets fund. Over time, Treasury actually even made money on that deal, but at the time, politically, it was hot potato. I mean, I don't think we could have pulled that over right now. You know what was the biggest mistake of AIG? When you sell regular insurance, you rely on lack of correlation between different policies. So if you sell car insurance, you know, the probability that you're going to have an accident is independent of the chances that I'm going to have an accident, unless we do race each other every day, right? Which means you're kind of diversified across people. You may have some correlation, but as long as that correlation is low, the law of large numbers work, no problem. But the problem with these credit default swaps, when things go bad, it goes bad for almost everybody. So when the crash hit, not only it was the Florida subprime rate mortgage-backed securities that went down, same thing also happened in Massachusetts. Same thing happened with corporate loans, sovereign loans. So they all went down together. So you don't have any benefits from diversification. That was pretty much uh, what drove the financial crisis. Not managing these exposures properly. It kind of created two positive things. One, uh, regulators started becoming more concerned about systemic risk, especially contagion risk. So when Dodd-Frank Act passed in 2010, they created a system called set of banks that are important to the system. Those guys were pretty much examined on a daily basis. You know, if you had more than $50 billion in assets, somebody from a team from your regulator actually had an office inside your headquarters. They looked at your live numbers every day. So if something is going wrong, they could do something. Otherwise, you were only examined every 3 months, but by the time your next examination comes, it could be too late. If you're a bank with only $1 billion of assets, yes, your shareholders are going to be very unhappy if you go down, but that's not going to affect other banks, or at least maybe a few banks, but not the entire system. But if Wells Fargo goes down, a lot of banks are going to go down because these banks lend money to each other at a much higher rate these days. And that's why, you know, Bear Stearns going down, Lehman going down was important because these guys had very high leverage positions. For example, when Lehman went down, their leverage was about 1 to 30. That means if their underlying assets lost only 3% of their value, the entire company was insolvent. And with long-term credit derivatives, that 3% happens sometimes with only 0.5% move in underlying interest rates. It's not that difficult. Well, you know, people had lended those $29 to Lehman. You know, those guys then have to make up for it, and it comes kind of a snowballs. The second was it created a long period of very low interest rates. In fact, we never went negative in US, but in Europe, short-term interest rates were actually negative. Until about a few years ago, the short-term borrowing rates or European Central Bank short-term rate was negative 0.75%. If you looked at bonds, Bund is short for Bundesrepublik, which are basically named for German bonds. Uh, Even 10-year bonds had negative yields. Here's what that means. I give you 10,000 euros. Let's say the 10-year yields were negative 0.5%. For the privilege of holding my money for 10 years, I have to pay you 50 euros every year. That's what I pay you interest, even though you borrowed the money. That's what negative interest rate is. After the COVID thing passed, they're now positive. But there's even, for example, let's look at the Swiss yield curve. Yeah, the 2-year bonds are negative 0.12%. So if I lend 10,000 Swiss francs to Swiss government, every year I also have to pay them 12 Swiss francs. That's what that means. They're doing it so that people, they are discouraging for people to convert their currency into Swiss franc. Because if they keep doing that, Swiss franc is going to gain a lot of value, which is going to decrease their competitiveness because they do a lot of exporting, things like watches and some other stuff. That's why they keep those rates relatively low. Okay, let's stop here. I'm going to post your Google folder and homework later today. Again, those of you who haven't picked a group yet, let me know. Otherwise, I'm just going to put you into a group. That's it. Only one of you or three of you have told me what group you wanted to be in. I'll see you guys Monday.